Is success in real estate just luck, or is there some kind of secret formula?
Yeah, that's a common idea, isn't it? That it's only for people who are already rich or just stumble into good fortune.
Right.
But today, we're looking at Ken McElroy's book, The ABCs of Real Estate Investing: The Secrets of Finding Hidden Profits Most Investors Miss. And it paints a very different picture, much more grounded, much more actionable.
That's right. Ken McElroy, he's not just some theorist. He's a seasoned pro, decades of real hands-on experience, especially, and this is key, in property management.
Yes, that's often the overlooked part.
Exactly. And, this isn't one of those books from someone who maybe lost money and now they're selling courses. McElroy offers this really refreshing, proven perspective. It's clear he's learned this stuff in the trenches.
And what really makes his approach stand out, and Robert Kiyosaki, the rich dad, poor dad guy, really highlighted this.
Oh, yeah.
Kiyosaki specifically pointed out McElroy's deep understanding of property management. He basically said, look, this isn't just one part of investing. It's the most important part. It's where the long-term game is played. It's where you either make or lose your profits, separating like real investors from speculators.
Okay, we want to give you that shortcut to understanding how to find properties, how to evaluate them, and crucially, how to manage them for real sustainable wealth and cash flow.
And we'll be zeroing in on his key points, the specific details he emphasizes that honestly make all the difference in this business.
All right, so with that goal in mind, where does McElroy tell us to actually begin? It's maybe not where you'd expect. He starts by challenging beliefs.
Yeah, it kicks things off by tackling these common myths head on. He calls them untruths paralyzing you with fear, which is pretty strong language.
It is.
These aren't just little misunderstandings. They're often these deep-seated beliefs that literally stop people from even starting in real estate.
Okay, so let's hit the first big one. I think this is what stops most people. You have to already be wealthy to invest in real estate. The idea you need a giant pile of cash.
Right. McElroy completely refutes that. He argues what you really need isn't necessarily your own huge savings, but a good deal, a deal that works financially on its own merits.
How does he back that up?
Well, he uses a really compelling personal story. He talks about his first investment, a condo for $116,000, where he did put in $20,000 of his own money.
Okay, standard enough.
But then he contrasts that with a later deal, a $9 million 182-unit apartment complex. Now get this. He put zero of his own cash into that deal.
Wow. How?
He raised $2 million from other investors. His stake was 10% ownership, and that stake ended up yielding him $900,000.
So that immediately begs the question, how do you get into a $9 million deal with no cash?
His point is twofold. One, partners help spread the risk, which is huge. And two, fundamentally, good deals attract investors. If the numbers work, the money will follow.
Okay, that connects to the next myth he busts, which feels related. You need to start small. Big deals are too risky. This sounds counterintuitive, right?
It does, but his logic is sound.
Mm-hmm.
He explains that with larger investment properties, the loans are often secured by the property itself, the asset.
Not necessarily by your personal finances.
Exactly, which, ironically, can make those larger deals less risky to you personally compared to, say, a single-family home loan that relies heavily on your personal guarantee.
Can you give an example of that?
Right, think back to his comparison. That $116,000 condo, that was 100% his personal risk. But the $9 million project, even with zero cash in, was less risky for him personally because it had professional management baked in, and the loan was backed by the building's income potential.
And the returns reflected that.
Massively. The condo gained only $5,000 in 5 years. His 10% share of the big apartment building, it gained $200,000 in less than 1 year. And he attributes that largely to management.
Okay, so there's a key principle there.
Yes. With commercial property, appreciation is linked directly to its cash flow. And cash flow is something you can influence, you can control through good management.
Unlike a house where you're mostly just hoping the neighborhood value goes up.
Precisely. Plus, bigger properties spread your risk. One vacancy in an 8-unit building hurts way less than one vacancy in a single-family rental. It's just math.
Got it. Now, this next myth, I feel like this one gets a lot of airtime, maybe on late-night TV. The idea you can flip your way to success or get rich quick with no money down.
Ah, yes, the siren song of flipping. McElroy is pretty blunt about this. He calls flipping very risky. He compares it to day trading stocks.
High risk, high stress, short-term focus.
Exactly. And those no money down deals, they sound great, but often they come with much higher interest rates. And you have zero capital left over for necessary improvements or repairs. You're basically just gambling on the market going up fast.
Which, as you said, is out of your control.
Totally. So McElroy's stance is clear. He doesn't believe in zero down or flipping as sustainable strategies. His whole philosophy is built around buying and holding income-generating assets.
Does he give an example of his strategy instead?
He does. He talks about a 208-unit property they built for $13.8 million. It later appraised for $16.3 million.
Sure.
Now, they could have sold it for a $2.5 million gain.
But taxes.
Right. That would trigger a $750,000 tax bill. So his strategy, refinance the property based on the higher value, pull out that equity tax-free, and use that tax-free cash for the next deal, all while continuing to own the original property and collect its cash flow.
That's the long game, sustainable wealth building.
That's his cornerstone. Long-term holds, strategic refinancing, using tax advantages. It's not sexy like flipping, maybe, but it's how real wealth is built over time.
Okay, so we've tackled the myths, we've cleared our heads. What's the very first action step McElroy insists on?
Goal setting. He calls it goal power. He says it's absolutely not optional. It's step number one.
And not just vague goals.
Definitely not. He stresses they must be measurable. Like, I will acquire 1 2-unit property this year, or I will earn $5,000 per month in passive income within 2 years. And, importantly, attainable, realistic.
He mentions the SMART test.
Yes. Specific, measurable, agreed upon, with partners, if any, realistic, and time-activated. It's a classic framework, but he really emphasizes applying it rigorously.
Does he share his own experience with goal setting?
He does. He talks about how his early goal was just sort of vague, like be my own boss. But that evolved into a very specific, measurable goal of achieving financial freedom through real estate. He also mentions the 7 laws of lifetime growth from Strategic Coach. And interestingly, balancing goals across family, marriage, and work, with work actually coming third.
That's a different perspective. Placing work third.
It shows a holistic view, doesn't it? Success isn't just about the money.
So once you have that SMART goal, what's next?
Communicate it clearly to everyone in your network, agents, attorneys, accountants, even friends and family. Tell people what you're looking for. This puts you in control, makes you the destination for opportunities that fit your goal.
And he suggests some practical behavioral changes too.
Yeah, small things that add up, like take a different route home from work sometimes, scout potential neighborhoods, use half your lunch break to make calls related to your goal. Cut back on TV time maybe, and dedicate that hour to working on your real estate business.
It's about actively carving out the time.
And perseverance. McElroy is very realistic here. He warns that property deals often take twice as long and cost a lot more than you expected.
Good to keep in mind.
And he cautions strongly against getting sidetracked. He shares a personal story about starting a carpet cleaning company on the side.
Oh, really?
Yeah, seemed like a good idea at the time, I guess. But it ended up costing him $250,000 and, more importantly, 2 years of lost focus on his real estate goals. A costly distraction.
Wow. That story really highlights the need for focus, and it leads perfectly into the next big piece. You can't do this alone. You need a team.
Absolutely. He drives this point home with another story, a cautionary one this time, about an investor from Seattle.
Okay.
This guy bought a 100-unit property down in Phoenix, sight unseen, never visited, relied on maybe some photos, and the seller's word. The place was a disaster, massive disrepair, apparently full of gang members. It was so bad, the local police wouldn't even go onto the property without backup.
Yikes. What's the lesson there?
McElroy calls it laziness on the front end, trying to save a few bucks or a bit of time by skipping proper investigation. It cost that investor a fortune to fix the mess. McElroy's point is blunt. The wise investor pays on the front end for good advice and thorough checks. Pay now or pay much, much more later.
So who makes up this essential team you need from the start?
He lists 4 key members. First, an attorney absolutely vital for setting up your business structure correctly, like an LLC.
A limited liability company, right, to protect your personal assets.
Exactly. Asset protection is crucial. Then, an accountant, you need solid tax advice from day one. Third, a good real estate broker who understands investment properties in your target market. And fourth, a property manager.
Even before you own a property.
Yes, because a good property manager can give you invaluable operational insights when you're evaluating a potential deal. They know the real costs of running things.
Makes sense. And what about partnerships? He mentioned partners earlier.
He has specific advice there too. He lists qualities to look for: ability to have healthy debates, open-mindedness, commitment, shared values, and mutual accountability. He uses his own partnership with Ross McAllister as an example. They have complementary skills, one focusing on construction development, the other on management operations. It works because they trust each other and have defined roles.
Okay, team assembled. Now, market research. You mentioned McElroy makes this sound fun. How?
He does. He frames it as a purposeful tax-deductible vacation, which definitely makes it sound more appealing than just staring at spreadsheets. He outlines a 3-level research strategy. Level 1 is research you do from home, mostly online. He uses their decision to expand it to Portland, Oregon, as an example. From Arizona, they researched Portland online.
What did they find?
Key things. Portland had an urban growth boundary, which limits future housing supply good for existing property values. They had progressive downtown planning, good public transport, high demand for downtown living and working. Employment was generally favorable, though statewide unemployment was high.
High unemployment. Isn't that bad?
Not necessarily. McElroy saw it as an opportunity to buy low when the economy is down. Contrarian thinking.
Okay, that's level 1. Level 2.
Level 2 is face-to-face. Boots on the ground in Portland, meeting local experts, property managers, brokers, lenders, even city planning officials.
What's the goal here?
To confirm their online findings, but also, crucially, to correct any wrong assumptions. For instance, they found there was actually more suburban overbuilding than they'd expected from the online data. This real-world intel helped them narrow their focus specifically to the downtown submarket, based purely on supply and demand.
And level 3?
Level 3 is the follow-up. Calling the referrals they got during level 2, signing up for local real estate newsletters, market reports, basically staying plugged in to become forever in the know about that specific market.
So the big takeaway here seems to be know your market deeply.
Absolutely. McElroy states it very clearly. The market is more important than property. You need to become a genuine expert in your chosen submarket, moving way beyond just gut feelings.
He mentions 3 drivers of supply and demand.
Yes, this is core to understanding a market. First, employment. Population tends to follow jobs. Second, population growth itself, driven not just by jobs, but by the area's persona, think places like Venice Beach or Scottsdale, that attract people for lifestyle reasons. And third, location specifics, things like drive-by visibility, unique qualities, being in a hot micro-location.
Any warnings about location?
Yeah, he warns against pioneering, buying too far out on the edge of development, hoping the growth reaches you. Risky. He also advises looking for markets where the cost of owning a home is significantly higher than the cost of renting. That makes multifamily rentals a really attractive and necessary option for people.
All right, so we've got the team. We've researched the market now, finding the actual property. He's not just looking anywhere, is he? He calls it searching for a diamond in the rough.
Exactly. He's very targeted. He gives his broker really precise parameters. For example, 150-plus unit communities built after a certain year, like 1988, high visibility. And here's a key one. He specifically looks for owner-managed properties.
Why owner-managed?
Especially those owned by people out of state. His reasoning is that these owners, often amateurs or just stretched too thin, are likely not managing the property to its full potential.
So there's hidden upside, untapped potential.
Precisely. He's looking for properties where a professional management approach can significantly increase income or decrease expenses, thereby boosting the property's value. He believes everything is for sale for the right price, even if it's not officially listed.
How does he even find these owners if the property isn't listed?
It's usually public information, county tax assessor records, state corporation commission websites. You can often track down the owner's name and address. He even provides a sample script for making that first cold call.
Really? What's the gist?
Just be direct and honest. Introduce yourself, say you invest in the area, you notice their property, and ask if they might ever consider selling. Then, crucially, ask if they'd be willing to share the rent rolls and operating expense statements. Get the data.
Okay, getting that data leads us right into what McElroy calls the absolute core, the must-remember chapter, right? The 5-step property evaluation.
Yes, this is the engine of his whole system. He says he's used this exact process for 15 years with outstanding results. His core belief: a deal is either good or bad based purely on whether the numbers work, period.
And he often makes an offer before seeing the property, based just on these numbers.
Often, yes, because this system gives you an objective valuation based on the property's current verifiable performance, not the seller's asking price or their rosy predictions about the future. It completely shifts the power dynamic. You're buying based on facts, not hype.
Okay, let's break down the 5 steps. Step 1.
Step 1, verify income. And this is critical. You have to distinguish between actual income, what it really brought in over the last 12 months documented, actual potential income, what it could bring in if 100% full at current rent levels, and future potential income, what it might bring in if 100% full at projected future market rents.
Which one does McElroy use for his offer?
Always the actual income. He calls this buying at wholesale. He avoids paying retail, which is based on future potential that might never materialize. He gives an example of a Phoenix property where the seller was projecting income over $6,000 higher than the actuals just by inflating the expected rent collections.
Wow. Okay, so verify actual income. Step 2.
Step 2, verify expenses. Get as accurate as possible here. McElroy points out that some costs, like repairs and maintenance, almost always go up as a building ages, not down like some sellers might project in their pro formas.
Pro forma meaning the projected financial.
Exactly, financial forecasts. He also says, check with utility companies directly for estimates, and always assume property taxes will increase after you buy it, because the sale price often resets the assessed value. In that same Phoenix example, his realistic expense projection was over $1,500 higher than what the seller was showing.
Okay, verified income, verified expenses. Step 3.
Step 3 is simple math. Determine net operating income, NOI. That's just your verified annual income minus your verified annual expense.
So in that Phoenix case,
His realistic verified NOI was $22,368. The seller's projected NOI, $29,547. That's a huge difference, over $7,000 lower on his calculation. This shows why verification is so absolutely critical. You can't trust the seller's numbers.
definitely not. Step 4, this involves the cap rate, right?
Yes. Step 4, find the capitalization rate and valuation. McElroy simplifies the concept. Your offer price, he says, should be your calculated NOI from step 3 divided by the appropriate capitalization rate for that type of property in that specific market.
Okay, remind us what the cap rate represents again.
The cap rate is essentially the expected annual rate of return on the property before debt payments. It's a
Yeah.
market benchmark. A lower cap rate generally means lower risk, higher demand, higher price. A higher cap rate implies higher risk or lower demand. So you find the typical cap rate for similar properties in your market.
Maybe by talking to brokers or looking at recent sales data.
Exactly. And you divide your verified NOI by that cap rate. That gives you your data-driven valuation. For the Phoenix property, using his lower NOI and a market cap rate, his calculated offer price came out to $255,926.
Compared to the seller's asking price.
The seller was asking $338,000. So McElroy's number was way lower, but it was based on reality.
Okay, final step. Step 5.
Step 5, calculate loan payment and profit, cash-on-cash return. Use an online mortgage calculator with your offer price from step 4 and current interest rates to figure out your annual debt service, loan payments. Subtract that from your NOI to get your projected annual cash flow before taxes. Then divide that annual cash flow by the total cash you'd need to put into the deal, down payment plus closing costs, to get your cash-on-cash return percentage.
And for the Phoenix example.
At his calculated offer price of roughly $256,000, the numbers showed a positive cash flow and a respectable 9.2% cash-on-cash return. But if he'd paid the seller's asking price of $338K, the calculation showed negative cash flow. He'd be losing money every month.
Wow. That 5-step process really gives you the confidence and the hard facts for negotiation, doesn't it?
Absolutely. Puts you in the driver's seat. You know what the property's actually worth based on its performance.
So when do you actually commit? After you have these numbers. McElroy has a rule for that too, doesn't he? Something about percentages.
Yeah, it's interesting. He says when you feel you know about 70% of everything you need to know about a property and the deal,
Yeah.
that's probably enough information to make a decision.
70%, not higher.
He thinks 60% is too little, you're guessing too much. But if you wait until you know 90% or 100%, you risk analysis paralysis, you'll overthink it and miss the opportunity. 70% is his sweet spot for moving forward with an offer.
And if the numbers just don't work, even after trying to negotiate.
He's very clear. It is perfectly okay to walk away. Learning about a deal, even when you don't close on, is never wasted time. It makes you smarter for the next one.
What tools does he use to actually make the offer and secure the property while investigating?
He talks about using a letter of intent, LOI, first, which is usually non-binding but outlines the main terms. Then moving to a formal purchase and sale agreement. The absolute key in these documents is including contingencies. Crucially, a financing contingency, you can back out if you can't get the loan, and a due diligence contingency. This gives you a set period of time to thoroughly investigate everything about the property before you're fully locked in.
And that due diligence period, he calls it an Easter egg hunt.
He does. It's your chance to dig deep and uncover anything the seller didn't disclose or maybe you didn't even know. You examine all the documents, leases, financials, maintenance records, and do thorough physical inspections of the property.
He shares some wild stories from his own due diligence hunts, right?
Yeah. Falsified rent rolls, apartments cannibalized for parts for other units, finding a tenant's loose boa constrictor,
A boa constrictor.
finding a naked man sleeping in what was supposed to be a vacant unit, discovering severe hidden roof damage. The list goes on.
So, finding problems during due diligence isn't necessarily bad news.
Not at all. He calls these discoveries golden eggs. Because if you find a major issue before closing, like serious structural problems, mold, fire code violations, you now have leverage. You can renegotiate the price downwards or require the seller to fix the problem before you close on their dime.
What's scary is what you don't find then.
Exactly. He says only the stuff that isn't found during due diligence is scary. Because once you close, any previously unknown problems become your expensive headache. He tells a story about a friend whose property had a massive raw sewage flood shortly after closing because the drainage system hadn't been properly inspected during due diligence. Very costly mistake.
Oof. Okay, so due diligence is complete. Contingencies are hopefully satisfied. What's the next planning step before you officially take over?
This is crucial. You create your detailed management plan and your operating budget side by side. They inform each other.
What's the difference?
The management plan outlines your strategies, how you're going to increase income, raise rents to market, add services, and decrease expenses, renegotiate contracts, improve efficiency. The operating budget then quantifies those strategies. It puts actual dollar figures on your expected income and all your anticipated expenses for the first year.
Who's involved in creating this plan and budget?
Your team. McElroy stresses asking what if constantly and brainstorming with your property manager, maybe your broker, your accountant. Look for those income-generating opportunities. Like what?
Maybe adding coin-op laundry if there isn't any. Charging a small premium for units with better views or on lower floors. Could you convert an underused storage area into a small fitness room or rentable space? He gives a really powerful example from his 182-unit property in Sun City, Arizona. Tell me about that one.
Okay, so in their planning phase, they budgeted $54,000 to buy a community van for resident transport. They also planned to charge $75 a month extra for desirable first-floor units. And they found they could renegotiate bulk cable TV and alarm monitoring contracts, save nearly $4,000 a month.
Just those few changes. What was the impact?
The impact was huge. By implementing just those planned operational improvements, they increased the property's value by over $2 million in the first year alone.
Wow. That directly ties operations to value increase.
Absolutely. It's the core of his philosophy. Good management creates value. So your budget needs to be comprehensive. He lists all the categories: payroll, admin costs, marketing, maintenance, repairs, property taxes, insurance, utilities.
You warned about utilities, right?
Yes, beware of master-metered buildings where the owner pays for all the tenant utilities in one bill. Very hard to control costs. You also need to budget for capital repairs, saving for future big-ticket items like roofs or HVAC systems.
What if, after all this detailed budgeting, the numbers still don't look good enough for the price you negotiated?
Then you have to go back to the seller. You present your findings, your detailed budget, showing why the property won't cash flow sufficiently at the current price based on realistic operations. You use your data to justify a lower offer.
A professional confrontation based on facts.
Exactly. It's not emotional. It's business. And if they won't budge and the numbers don't work, you have to be willing to walk away, even at that late stage.
Okay, so let's say the deal closes. You own the property. Now the real work begins, right? Management.
That's right. And McElroy emphasizes his success comes from never cutting corners in the earlier stages, the valuation, the contract, the due diligence, and especially that detailed property planning. He always goes in prepared.
What's his take on day-to-day property management?
He calls it a 365-day-a-year, 24-hour-a-day job, whether you do it yourself or hire it out. It's about executing your plan, constantly looking for ways to maximize that cash flow, and inevitably solving problems daily. You need systems for everything: leasing, rent collection, maintenance requests, handling late payments, legal procedures.
Any specific management practices he really emphasizes?
One he's adamant about.
Mm-hmm.
Run criminal and credit background checks on every single applicant, no exception.
Why so strict?
He talks about the domino effect of letting in just one wrong person. He shares a story about discovering a registered sex offender had moved into one of his family-oriented properties. The immediate action required: communication with other residents, dealing with potential legal issues. It highlights the massive liability and disruption that thorough screening helps prevent. Taking care of your current, Good residence is also key, he says. And always budget for the unexpected things will break.
What if you don't want to manage it yourself, which sounds like a lot of work?
For sure. If you hire a professional property management company, he provides a great comprehensive list of questions you should ask them.
Such as?
What are their fees? Typically 4 to 8% of gross rents for multifamily. What's their specific experience with your type of property? How do they handle accounting and reporting? Can you get references? What are their policies on screening, leasing, evictions? Are they affiliated with professional organizations like IRM, which offers CPM designation, or NAA? What training do their staff get? Are they properly licensed?
That's thorough. And reasons to fire a manager.
Clear reasons. Neglecting the property, consistently high vacancy or turnover rates, poor financial reporting, not communicating. Basically, if they aren't executing the plan and protecting your asset.
Okay, last major topic, selling. McElroy mostly advocates buying and holding, right? But sometimes you do sell.
Yes, while holding is the default, there are strategic reasons to sell. Maybe the market has peaked, maybe you have a much better opportunity elsewhere, maybe that property no longer fits your long-term goals. When you do sell, the goal is to flip the script. Now you want to present the property at its absolute best, its retail potential, to maximize your price.
How does that differ from how you evaluate as a buyer?
It's almost a mirror image. Remember how as a buyer you focus on actual income? As a seller, McElroy gives some counterintuitive advice. You want your rents to be right at market rate, even if that means having a few vacancies when you list it.
Really? Wouldn't 100% occupancy look better?
You'd think so, but he explains why not. Let's say you have a 20-unit building, fully occupied, but your rents are just $35 below the current market rate per unit. That might seem small, but a savvy buyer will look at that lower income stream, apply a market cap rate, and it could easily translate into an $84,000 reduction in the property's calculated value and their offer price.
Because the buyer is valuing based on that lower actual income.
Exactly. And buyers will likely factor in a typical 5–7% vacancy rate in their own projections anyway. Right. So having rents at full market potential, even with a couple of empty units, often leads to a higher overall valuation and sale price.
Interesting. What else do you do when preparing to sell?
You run expenses as lean as possible in the months leading up to the sale. Defer non-essential repairs if you can. Make sure the curb appeal is great. And work with your broker or property manager to find qualified buyers who understand investment properties.
And a final warning about selling.
Yes, a critical one. Never sell without having a clear plan for what you're going to do with the proceeds, especially considering taxes. He tells a story about a friend who sold a property, then scrambled desperately to find any replacement property within the tight time frame for a 1031 exchange, a tax deferral strategy, to avoid a huge tax bill.
And ended up making a bad purchase out of desperation.
Precisely. McElroy says he never sells a property unless he already has at least 3 or 4 replacement deals in the works. Always have your next move planned to keep building wealth and manage tax implications.
Wow. Ken McElroy's The ABCs of Real Estate Investing. It really drives home that success here isn't luck or magic, is it?
Not at all. It's about discipline. It's about thorough research, knowing your numbers cold, building a great team, and managing strategically, being prepared.
Yeah, understanding those crucial details of property management, valuing based on facts, not fantasy, and making those data-driven decisions. That seems to be the path to sustainable wealth and financial freedom he lays out.
Exactly. It's methodical, maybe less glamorous than some portrayals, but it's proven.
So a final thought for you, our listener. After hearing McElroy's very grounded, practical approach, what deeply held myths about investing, maybe ones we didn't even cover today, might you still be holding on to? Could those beliefs be preventing you from seeing potential hidden profits in real estate right now?
And perhaps more pointedly, how might embracing a really structured, fact-based system like McElroy's 5-step valuation process actually transform your current financial hopes or dreams into concrete, actionable goals you can start working towards?